Today we are joined by Frank Kopfinger, Head of Investor Relations at LEG Immobilien SE, to present the company's full year 2025 financial results. As one of Germany's leading listed residential real estate companies, LEG Immobilien offers investors a highly relevant view into rental growth, recurring cash flow generation, portfolio quality, and capital discipline in the German housing market. Frank, we are very pleased to have you with us today. The stage is yours.
Hello, I'm Frank Kopfinger, Head of Investor Relations at LEG. With our full year 2025 results, we provided the markets with a couple of highlights, which I'm going to address in this short presentation. First, we have delivered an AFFO, which is our cash earnings metric, of 220.5 million euros, marking a 10% increase over the previous year. And this is the highest level in our company's history. Second, building on this success, we are proposing a dividend increase of 8% to 2.92 euros per share. This reflects a 100% payout ratio of our AFFO. Third, we also made some solid progress on the balance sheet. Our loan-to-value ratio has improved to 46.8%, and we remain on track to reach our 45% target in 2026. This improvement was supported by a 3.0% positive valuation effect, as well as around 190 million euros of disposals, which got transferred in 2025. Another 70 million euros of disposals have been signed additionally and will get transferred in 2026. Fourth, we also made progress with our Glasmacher development plot in Düsseldorf, which is the biggest inner city residential development plot with more than 190,000 square meters. Here, we have signed a purchase option with an international real estate developer with Heinz. And fifth, for 2026, we confirmed our guidance and we continue to aim for an AFFO of 220 to 240 million euros. And finally, we also provided markets with two specific midterm growth drivers. A, on subsidized units, where we expect a contribution to rent growth from 16,000 units, which get off restriction of around 1 percentage points contribution to the overall rent growth. And B, from digitalization, where we expect a contribution to FFO1 and AFFO of around 10 million euros by 2030. Let me walk you now through some of those highlights. On the financials, our strong AFFO of 220.5 million euros is driven by several effects. First of all, the rent level grew by 7%, driven A, by the acquisition of BCP, which we fully integrated at the beginning of 2025, and B, the like-for-like rent growth of 3.5%. This reflects a strong 4.0% rent growth for the free finance part, and we saw some negative effects on our top line from the disposals of 16.8 billion euros. Second, we had a broadly stable cost base. This is why we increased our adjusted EBITDA margin slightly to 78.1%, up by 20 basis points. Third, we continue to benefit from low cash interest costs, which remained low at 1.66% for our entire debt book of around 10 billion euro, with an average maturity of 5.5 years. And fourth, there have been on our investments into our portfolio, which we increased on a square meter basis from 34 euro to 36 euro per square meter, and which is reflected in the waterfall chart by higher maintenance and higher capex spending. Our green ventures, i.e. Renovate, which is our serial refurbishment business, Thermios, our smart thermostats business, as well as Decarbo, which is our heat pump business, they reported for the first time as a new line item within our P&L. They reported a negative 4.2 million as they are still in the startup phase. We expect overall until 2028 a contribution of 20 million euros from our green ventures until 2028 on a cumulated basis, i.e. they will become a growth driver going forward. And overall, this led to an increase of the FFO1 by 5% to 481 million euros, and the AFFO, as you see in the waterfall chart, by 10% to 220.5 million euros. And with this, I come to our financial profile. We believe we are well positioned in the current environment where we saw a high volatility on bond markets. 2026 maturities of roughly 1 billion euros are covered by our strong cash position or new refinancings. By the time of reporting in March, we redeemed already our 500 million euro straight bond, which was due early 2026, and which represents half of the 2026 maturities. Our average interest rate stands at still very low 1.66% at the end of the year, while the average maturity remains also high with 5.5 years. The interest rate coverage ratio stands strong with 4.3 times, reflecting our earnings power on one hand and our low interest costs on the other hand. The LTV improved to 46.8%, which was driven by our disposals, our AFFO steering, and a positive 3% valuation effect. Our NTA per share stands now at 137 euro per share. And with this, I come to one of our midterm growth driver, our subsidized units, which get off restriction in 2028. Today, we have around 30,000 subsidized units total in our portfolio, which are subject to rent regulation under the so-called cost rent regime. This represents overall currently 17% of our entire portfolio. These units are currently rented out for about 5.40 euros per square meter, which is significantly below market levels. By comparison, the relevant market rent for a similar mix of units is roughly 9 euros per square meter. This means there exists a rent gap of more than 60%, and as these units get off restriction, we can start closing that gap in a controlled and sustainable way, like we have done with smaller numbers of subsidized units over the past years. In general, we will apply the 15 or 20% rent increase on all units getting off restriction, depending on whether they are based in tense or non-tense markets. However, the cost rent adjustments, which we do now in 2026, as well as the new lettings in 2026 and 2027, they will absorb part of that maximum rent increase potential. So as of today, we assume that this limits the rent increase potential on those units to around 12% in 2028. And on a portfolio level, that alone it translates into about 1 percentage point to our overall rental growth in 2028. And importantly, the effects do not stop there. This will become a recurring and predictable growth driver for our residential portfolio, as going forward we can adjust rents within the regulation by 15 or 20% every 3 years for sitting tenants. And it will take quite some time until we can close the gap towards the market rent level. And with this, let me briefly walk you through our guidance. We confirmed our 2026 guidance, which we presented already in November 2025. We expect the AFFO, or main KPI, to reach a level of 220 to 240 million euro. This will be driven by a rent growth of 3.8 to 4.0%. The rent growth is to increase by around 40 basis points over 2025, where we achieved 3.5%, and reflects the positive contribution in 26 from the so-called cost rent adjustment for our subsidized units. We expect the EBITDA margin to deliver again 78%. We continue to invest significantly into our portfolio, i.e. more than 35 euros per square meter. So quite in line with last year's investment. And as said on LTV, we expect to reach our target of around 45% in 2026. This will be driven by a mix of further valuation effects as well as disposals. Certainly, faster disposals can shift the timeline forward by when we achieve the 45%. And with this, I come to the end of my presentation. I hope it gave you a good overview of our full year 2025 results, and you certainly find the entire reporting package and set on the webpage within the IR section. Should you have any questions, then please do not hesitate and reach out to me or the entire team. Thank you and goodbye.
Thank you, Frank, for the clear and insightful overview of LEG Immobilien SE's full year 2025 financial results and outlook. Investors who would like to learn more about LEG's portfolio strategy, recurring cash flow profile, and long-term value creation are invited to explore additional company presentations and financial result videos.
Disclaimer. As described in the legal section on our website, c11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. C11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.